Well, happy Sunday night, Patriots. I am here to do a little update, a little news for you. Not something I usually do, but I thought it was important because as silver and gold stackers, this is information that some of us have known for a while and some of us don't know and some of us are just learning. So I want to get into this. There is a commodities exchange group that determines spot price on a minute-by-minute basis. And the way they decide that, there's supposed to be a reason they decide what spot price is. And spot price, as I said in the last video, would be the price of silver or gold as it's mined and comes out of the ground, what we would need to pay for that kind of labor and the human effort. Well, the commodities exchange has been holding down silver for a long time, and it's very undervalued, especially considering the demand on silver, which is much, much more than gold. In fact, if we could put silver at its price that it should be, looking at history and how silver and gold have increased in value, it should probably be somewhere around $600 or $700 an ounce. Now, while that's a very positive, exciting deal for those of us who want to stack silver, it's not good in the long run as far as selling back or buying with it, because the purchasing power is being held down to try to bolster the dollar because the Fed wants us to trust the dollar. And that could be wrong, but that's my opinion. And so on this article, though, we're going to see that that is exactly the case, that it's been being held down illegally. So this is an article called A New Silver Issue for the Justice Department, and it's on here, this Silver Phoenix 500 Preserve and Build Wealth website. If you want to find it yourself, you can just do a quick search on it, or I might even be nice enough to provide the link down below. But I'm going to run through this real quick. I'm just going to read it. It's now been 4 months since the U.S. Department of Justice secured a criminal guilty plea from the former trader from J.P. Morgan for spoofing and manipulating precious metals prices on the COMEX, and 3 months since that plea was unsealed. In its announcement on November 6, the Justice Department made it clear that it was engaged in an ongoing investigation into COMEX precious metals trading by no less than 3 of its important divisions: the Criminal Division, the Federal Bureau of Investigation, and the U.S. Attorney's Division. And there's the link if you want to look at the organization chart for the DOJ. While it's no small matter for suspected criminal activity to be pursued by 3 separate divisions within the Justice Department, yesterday's release of the still-delayed Commitments of Traders COT report for positions as of January 15th indicates yet another important division of the DOJ should be involved in the current investigation, the Antitrust Division. Incontrovertible evidence in yesterday's COT report indicates serious violations of monopoly and restraint of trade issues in COMEX silver futures. And so anyone who is not familiar, a lot of us have known this. It's been a deal with J.P. Morgan, and that comes from the Fed. And you look at the guys from Jekyll Island, and we're looking at Rothschilds and people like that when it comes to these sorts of things, having control over our currencies. This is not a new issue in that I've continuously raised it over the years, but yesterday's COT report indicates it is imperative for the Antitrust Division to consider the matter in light of the current COMEX precious metals investigation already underway. That issue is the concentrated holdings of the 4 and 8 largest traders on the short side of COMEX silver futures. As of the close of business on January 15th, the 8 largest traders on the short side of COMEX silver futures held a net pure short position of 95,577 contracts, the equivalent of nearly 478 million ounces of silver, or roughly 60% of annual total mine production. The 4 largest traders held a net short position of 70,627 contracts, the equivalent of more than 350 million ounces of roughly 40% of the total annual world mine production. In terms of the average short holdings of each trader, the 4 largest traders average more than 87 million ounces per trader, while the 8 largest traders hold short nearly 60 million ounces per trader. No silver mining company produces 60 million ounces per year. Moreover, silver prices traded flat to lower over the reporting week, finishing at $15.62. That represents a price barely at or even below the cost of production for a primary silver miner. So the thought that silver miners were rushing to sell short and hedge production is absurd. Besides, mining companies have to disclose such dealings separately, and no such filings have been reported. There can be little doubt that the 1 week increase in the concentrated short position of the 8 largest traders of 4,935 contracts, which is nearly 25 million ounces, was strictly the work of speculating banks masquerading as legitimate commercials. The issue for the Antitrust Division of the Justice Department is what the effect the pure short sale by speculating banks led by J.P. Morgan of 60% of world silver mine production has on price. The basic role of the division is to ensure that monopolistic pricing forces don't interfere with the workings of the free market. A free market is defined by competition by as many market participants as possible. A world commodity such as silver would require more than 4 or 8 large traders to be considered free. Yet, according to data published by the CFTC, that is precisely the number of traders determining the price of silver. So what we see here, just my quick throw in case you're unsure, is we see a monopoly of forces that are providing a spot price for silver and clearly holding it way, way, way down under what it should be. So moving on. The first question the Antitrust Division must ask itself is what the price of silver would be if, instead of 60% of world production being held short by just 8 speculating banks, that short position was held by many more traders than just 4 or 8 large traders. In other words, what would it take to induce many more traders than just 8 traders to sell short the equivalent of 478 million ounces of silver? The answer is simple: much higher prices. Stated differently, if the concentrated short position of 478 million ounces, the 8 largest traders didn't exist, the price of silver would be substantially higher. In a nutshell, that's prima facie proof of manipulation. In a nutshell, that's prima facie proof of manipulation. Yeah, we know this. We know it's being held down. We know that the price of silver where it is right now is way under what it takes to get it out of the ground. But yet there it is. All right, moving on. The second question the Antitrust Division should ask is how this concentrated silver short position has been allowed to exist, and what do the existing regulators, the CFTC and the CME Group, say to allegations this is prima facie proof of manipulation. After all, no commodity has a concentrated short position that comes close to COMEX silver when compared to actual world production, consumption, and inventories. When it comes to concentrated short positions, COMEX silver is in a class of its own. The only answer the CFTC and the CME Group have been able to mumble on those rare occasions when they even bother to respond, and that's not in the last 10 years, is that the big concentrated short traders are just making markets and providing liquidity. If the church lady from Saturday Night Live fame were around, she would surely say, well, isn't that special? Commodity markets are designed to be open auction markets, not run by market makers, and the only liquidity provided is naked short selling designed to cap prices. I would expect that the Antitrust Division would be able to see right through such a bogus response. I suppose J.P. Morgan, alone among the other big 4 and 8 short sellers, must be able to claim it is hedging against its massive physical silver holdings. But I would hope that the Antitrust Division would be able to see through the illegitimacy of JPM's argument. J.P. Morgan was the biggest COMEX short seller long before it started to accumulate physical silver at the depressed prices it had caused to be depressed in the first place. So for it to claim it is now legitimately hedging when it adds to short positions is bogus. In terms of total world inventories, the concentrated short position in COMEX silver futures by the 8 largest traders, 478 million ounces as of January 15th, is roughly 25% of the estimated 2 billion ounces that exist in the world in 100-ounce bars. In gold, the less than 18 million ounces held short on that date by the 8 largest short traders in COMEX gold features measured against the 5.5 billion ounces of gold that exists in the world comes to 0.03%. That's 25% of world silver inventories and less than 0.5% in gold. Yes, I believe gold is manipulated in price by the same forces that manipulate the price of silver, but nowhere near to the same extent. As much as I pointed out the manipulation effect on the concentrated short position over the years, I have been just as consistent in providing the one sure cure or remedy, namely position limits. This is the issue that the CFTC and CME Group have stalled on for years. The issue is clear. For decades, a handful of large traders, mostly banks, right, central banks, we're talking elite-owned Fed banks, have conspired to manipulate silver prices by selling short massive quantities of COMEX futures contracts in any amount necessary to cap prices until prices fell under the weight of the excessive short selling. For the past 11 years, JP Morgan has been the ringleader, backstopper, and main beneficiary of the manipulation, greatly expanding its unfair advantage by conniving to accumulate physical silver at a depressed price for the last 8 years. Should the Justice Department and its antitrust division fail to act against this crime, conspiring manipulators will have pulled off the financial crime of all time. And folks, I don't think that's going to happen. And I have my reasons for it. You can call it political. You can call it whatever you want. It has nothing to do with politics. It has to do with who's in power and who's willing to fight this sort of system. And Donald Trump is willing to fight this sort of system, and we've seen it. He's up against deep state, like him or hate him, believe it or don't. He's up against deep state on a daily basis. And I have high hopes that he will end the Fed. And if we look at this, what is this? If you don't understand what this is all saying, it's saying that if you look at the price of silver to gold, its natural value is its natural ratio is somewhere around 16 to 1. And we're seeing now that'd be 16 silver troy ounces to 1 ounce of gold, or 18 maybe, somewhere around there. But what we're seeing now is the ratio is 85 to 1. And that is huge, because if you had gold, you might as well trade it in for silver right now, because you're going to get a hell of a lot more silver. You're going to get 85 pieces of silver for 1 ounce of gold right now that you normally only get maybe 35, which is the average, and really should only be getting 16 or to 18 pieces. So I'm hopeful. I believe in the president, and I trust that he will end the Fed and we will make this a new day. But what does that mean for us? If that happens, the price of silver will go up, which, just like Mike Maloney says, will make it unobtainable and unattainable pretty soon. And so you better buy in now. Don't waste time. Don't wait for it. So, hey folks, thanks for joining me. Please click like, share, and subscribe. Click the little bell on the subscribe, otherwise you won't get notified when I put a new video up. So I appreciate you listening and watching for the whole video. I appreciate you being here, because it's you that matters, and it's you that I want to get the truth out to and to help. So God bless you, Patriots, and good night.